It's time to get in editor's cut going today. And Alex, you are the judge and the jury.
Yes.
Who are the two fighters?
The two fighters is the one that could have introduced himself but is walking towards the podium. It's a mano a mano. But then on days following the day that we saw yesterday, you're tempted to call a peak because there is so much selling that you'd be forgiven for thinking that everything that came to that point is a distant memory. So from that perspective, what we're trying to do is we're going to do both cases. The gentleman who just walked in with a red tie, I was going to suggest that they exchange ties, but Mr. Muralidhar Swaminathan is not wearing a tie. So I would have said wear a green tie, wear a red tie. Because
I chose not to wear a tie. I didn't want to paint it in a color.
He doesn't want to paint a color. But to give you a perspective and how I'm going to suggest doing this very quickly, Neeraj, is that you're arguing for a bull case. It's not over yet. Murli is arguing against that we've hit the peak. Each of you make your strongest points first. If you've got a counter, you can come in on the counter as soon as the point is made. So since we're looking at the kind of cuts, and since Neeraj might be in the minority, I'm going to start with him. Neeraj, why are you saying it's not yet over?
So, as an investor, Alex, I would really worry if I was in the late stage of a valuation cycle and a late stage of the economic cycle. That's when bull markets typically peak. Are we at a late stage of a valuation cycle? You could argue yes. Are we at a late stage of an economic cycle? Overwhelmingly no, right? We are certainly not there. I mean, look at all the capex plans, etc. So that's sorted, right? Now, is India the oasis of growth? That's the question that you got to ask. High frequency data recently that has come in from various factors, including the HSBC flash PMI or the PMI data, is looking very strong economic growth. Petrol consumption, four-wheeler growth, two-wheeler growth, steady to higher in Jan, that is the latest data, versus all of 2023, by the way. So that's data for you. Non-food credit growth is at 20.4%, much higher than 2023 averages. And RBI projections of 7% GDP growth, again, revised higher. So that's the third point. And, we've been talking about this pain in the small and mid caps or the kind of rally that they had. Look at the earning projections that have come in the small and mid cap space for 2024, 2025. Free float PAT growth, by the way, I'm talking about Nifty mid cap 100. FY24 estimated 42%, FY25, yes, lower, but still a healthy 21%. Small cap 100, 33% for FY24, 23% for FY25. NSE 200, a wider bucket or a bigger market bucket, 31% FY24, 15% FY25. So the numbers are not wrong. Muralidhar Swaminathan, why are you countering my argument?
Do you have a counter to that?
Yes, I have some counterpoints. Agreed, all these noises are there. I'll call them noise because they are all projections and we have gone to the extreme. The most important point I would like to make is that I'm sticking my neck out. This is something we discussed day before yesterday, even before yesterday's crash. It's the end of the blind bull run. I'm saying end of the blind bull run because we were running blindly and we were pumping up the market, we as in the markets, not you and me.
With journalist salaries, we can't do anything.
See, beyond a point, you can't pump up. The balloon will burst, and it happened yesterday. That's the first side. The most important thing is, greed cannot last forever. There has been an element or a strong element of greed in every investment, every trade that has been made over the last 3 months.
Yes.
That's number one. So greed is out, but fear is not in. Let me be very clear.
Sentiment is kind of shifted, not entirely though.
Not entirely. The sentiment is shifting. Caution has come in. We as responsible journalists, we need to stop at some stage and take a look, and which is what we did, when we broke the first story about the stress test, which Sajid Mangat, my colleague, broke that story. The second point, what's the most important thing here? The small cap bubble has been pierced. There was a bubble, there was euphoria, we all know that. Every small cap you would have touched would have gone up by 30, 40, 100, 150%. That bubble has been pierced. You can't blindly keep investing. Mutual funds know that. We all know that. That's the second point. I'm just setting the context.
Sure.
Now, the question is, will there be a bull run in the current financial year? Maybe, but it will be in small bouts. It will not be a continuous, blind, relentless bull run. That's the point I'm trying to make. So making money is not going to be easy this year. I'm sure you all are agreed on that point. Maybe you can make 8%, maybe you can make 10%, you can't make 20% the way you did in 2023. Now, why am I saying this? There has been a lot of high decibel noise around elections, around economy. These are lofty projections, and most of them have been priced in.
Okay.
You know, I think at least 90-95% of what we are projecting, whether it is 7% growth or whether it is the capex taking off, they are all mostly priced in. That's my first
or the
argument.
outcome of the general election.
Outcome of the general election is the most important thing. See, somewhere mid-January, early Feb, when the Prime Minister, after the inauguration of the Mandir, it was very clear that the election campaign has started, and very clear that the Prime Minister knows that BJP is going to get, whether it's 350, 370 or 400, no surprises there. So that surprise element is gone. The surprise element on the negative side may not happen, most likely unlikely to happen. But what is left after this? There is absolutely no trigger for us to go further. So you need triggers. The triggers might be there. Maybe around the election time, you might see one surge in the rally. After the results come, it could go by 100, 150, 200, whatever. So the targets we don't know. It could be 23,000, it could be 24,000, but from here to there, it could be short-lived. Sure. There might be a bounce, but that could be short-lived. You need to watch for that one. The other point I want to make is that broader, moving away from elections, after June, sometime in July, the budget will come. The roadmap for development, growth, all those things have been already kind of set. They are all set. So it's a question of action that we need to see, reforms we need to see, and earnings we need to see going forward. That is one. Now, what are the risks to the growth? See, the risks to the growth are there over the next 6 to 8 months. Number one, consumption expenditure is going to go up.
For the government?
No, not just for the government, even for the public.
Okay.
Because there will be more money in the hands of the public. One, because elections are coming. Two, PSU bank ad hoc salaries, wage arrears are being given. It will run into several thousand crores. Central government is paid DA. That is the second point. Inflation is going up. Inflation is not coming down because of all this.
Debatable, but okay.
Yeah, no, inflation is still going up. You can see on the ground. You know, there is no surplus. So inflation is going up. It is eating into your disposable, surplus disposable income. Now, therefore, the question of pivot. Pivot right now is in the pits, and interest rate cuts cannot happen in my book, at least for the next 6 months.
Okay.
If rate cuts are not going to happen,
has he revised his
argument?
He has, right? Very
we
cleverly. Yesterday he was saying a different number.
No, I'm going to an extreme. If I go to the extreme, it will be at least a year.
Okay, fine.
I don't see that happening because the difference between the targeted rate and the current rate is still very wide. It will take, I'm saying, I'm being optimistic
fair point.
for 6 months, because after 6 months, your festival season begins.
Yeah.
It'll be even worse. So I'm not going to that extreme. There is an outside chance if supplies are maintained.
Sure. Okay, so I'll just counter.
Okay.
Sorry, if you have a point
No,
more, because I just want to bring in numbers here.
One more before you bring numbers.
Yeah.
So therefore, I'm saying forget rate cut for at least 6 months, which is the common narrative for all of us. If rate cuts are not there, pushing growth becomes tougher.
Agreed.
If growth becomes tougher, earnings delivery becomes even more tougher.
Got it.
The last and the most important point, over the last 3 months, the market has been telling me this story. There has been a rotational game. Today it's FMCG, tomorrow it is metals, the day after tomorrow pharma, and everything that is not run is running. For instance, I think even the flattest of the flat, SBI, Mahindra and Mahindra, they've all run up. So the market is telling me a story that the rotation game has happened, and it's not as if you see green every day on the Nifty or the this thing. So therefore, my argument is blind run is over.
Yeah. So let's allow Neeraj to counter with a few points.
Yes.
No, so actually, I'll make this quick.
Yeah.
We are already 8:27. But why is this not the peak? That's my limited point, because I think there is further room to go. Look at history. Nifty 50 forward P is at 20 times, by the way.
Yeah.
So while you could argue that it's expensive, historically, October 21 peak was much higher than that. Okay, so part one. That
it's close to 30, right?
Yeah, no. Nifty multiple wasn't 30; it was 24 times.
24.
But still,
those are small caps were about 30.
Yeah, which they might still be.
Yeah.
Maybe after the correction, they're at 28 or 27. What knows?
Possible.
Yeah. So that's part one. Corporate profitability to GDP ratio. That's a metric. 5.8% is still below the previous peak as well. Right. That's part two.
Sure.
Nifty earnings have grown at a CAGR of 21%. If you assume even 15% for the next 2 or 3 years, they make the valuations look a lot more reasonable than what they are right now.
Right.
And India tends to get a higher P multiple. Why? Because the ROEs are much better. So the corporate ROEs are currently at decadal highs. 15% ROEs. Show me a market across the emerging market pack which has got corporate ROEs at 15% and therefore enjoying the kind of multiples. And by the way, just the last point, even when we talk about multiples of India being high, etc., look at the PEG ratio, which is what people refer to in a high growth area, right? Look at the PEG ratios. China is cheap, but for a reason. India PEG is at 1.2 times, Korea 1.5, Mexico 2.78.
How do you describe that?
The price earnings to grow multiple, right? So India is not terribly expensive. 1.2 is fine for a country which is the only oasis of growth. So the only point that I'll rest is that yes, we've moved up quite a bit, but we are far away from when peaks are formed.
And also on the fundamentals, balance sheets are significantly stronger than they have been in the past.
Yes.
Allows for leverage to be taken to fuel the next leg of growth, possibly.
All those things are priced in.
All those things are priced in. So, well, look, from my perspective, I don't want to call it. I want you to call it. Let us know what you think in the comment section. In fact, whether or not you bet that the bull run is nowhere close to getting over, the peak has not been hit, at least in the near term, or if you think Muralidhar Swaminathan is right in his statement that, in fact, all of that is priced in and the blind bull run is now over.